Ladies and gentlemen, brace yourselves because we have some shocking news to share with you today. One of the most prominent banks in the United States, Silicon Valley Bank, has just collapsed, leaving many investors and customers in a state of panic. With its reputation for being a tech-savvy and innovative financial institution, the news of its collapse has sent shockwaves throughout the entire financial industry. So what happened? And what does this mean for the future of the financial system? In this video, we'll delve deeper into the story and explore the implications of Silicon Valley Bank's collapse. Please subscribe to this channel if you haven't, and if you are a returning subscriber, thank you for the support. This is what you might have missed. Silicon Valley Bank, a major lender for U.S. tech startups, has gone belly up and sent shockwaves through the financial industry. It's the biggest bank failure since the infamous 2008 financial crisis, and it's got everyday investors and savers biting their nails in anticipation of what's to come. Now, before you start stuffing your money under your mattress, let's get some expert opinions. According to the financial gurus, there's no need to panic just yet. Sure, the equity market might take a bit of a hit in the short term, especially for those invested in bank stocks. So what should you do if you're feeling a bit queasy about the whole situation? Well, according to Mike Bailey, Director of Research at FBB Capital Partners, the best strategy might be to just chill out and let things play out. If you're saving for long-term goals, this SVB news is just a minor bump in the road. Why are some people panicking? Brace yourselves, because we're talking big numbers here. We're talking billions. We're talking about the list of companies with Silicon Valley Bank deposits. First up, we've got circled a whopping $3.3 billion in SVB deposits. That's right, a billion with a B, and they're not alone. Roku has $487 million in deposits, BlockFi has $227 million, and Roblox has $150 million. The list goes on and on. We've got Jingo Bio with $74 million, Arrhythm with $55 million, Rocket Lab with $38 million, Sangamo Therapeutics with $34 million, Lending Club with $21 million, Payoneer with $20 million, and that's just the tip of the iceberg. But wait, there's more. These are only the companies that have disclosed their exposure so far. Who knows how many more companies are out there with billions of dollars in SVB deposits? It's like the world's most expensive game of hide and seeks. And to make matters worse, SVB has nearly $200 billion in deposits, with 97% of those deposits above the $250,000 FDIC limit. That's a whole lot of money that could potentially be at risk. So what does all of this mean? It means that the fallout from the SVB collapse could be huge. We're talking about billions of dollars potentially at risk here. It's a situation that's going to make some heads spin. What are the chances that this is similar to the 2008 financial disaster? The question on everyone's mind. Is history about to repeat itself? Are we going to see a rerun of the 2008 financial crisis? The good news is, it's not very likely. Let's break it down. Back in 2008, Silicon Valley Bank had a lot of its assets tied up in its investment portfolio. But, as we all know, bonds don't always behave the way we want them to. The value of those bonds dropped like a hot potato when the Federal Reserve hiked interest rates to control inflation. But here's the thing, the banking world has learned its lesson. Regulations have been put in place to make sure banks hold enough capital buffers to protect against systemic risks. That means, even if they are holding onto a chunk of unrealized liabilities, they're still well capitalized. Susanna Streeter, the head of money and markets at Hargreaves Lansdown, confirmed this when she said, even though they are sitting on a big chunk of unrealized liabilities because the value of the bonds that they hold has dropped, they are still well capitalized. So we can breathe a little easier knowing that the big banks are in a much better position than they were in 2008. But what's the hope for those who have money in smaller regional banks? You might be wondering, should you be worried about your money? The good news is, you don't have to panic just yet. According to FBB's Bailey, regional banks, for the most part, are in much better shape than Silicon Valley Bank, SVB. However, many regional banks also hold long-dated treasuries, which were purchased when interest rates were near zero. And as we all know, when interest rates go up, bond prices go down. That means those assets are worth less now. So the question is, what happens if lots of customers try to pull their money out too quickly? Well, those banks would have to sell the holdings at a loss to cover the withdrawals. Max Gochman, the head of Mosaic Investment Strategy at Franklin Templeton Investment Solutions, recommends considering alternative options for storing your money if your bank has exposure to digital assets or holds risky securities. As he put it, what we're seeing now is a contagion, where rumors become self-fulfilling due to capital flight. Will FDIC insurance provide protection? If you're a U.S. investor, the Federal Deposit Insurance Corp, FDIC, has got your back. In the event of a bank failure, the FDIC secures deposits of up to $250,000 per depositor. That means, even if your bank goes belly up, you won't have to kiss your hard-earned cash goodbye. And in case you're wondering about SVB, don't worry. The FDIC has got it under control. Insured depositors will have access to their funds by no later than Monday morning, 13th, March 2023. But what if you have more than $250,000 in your account? You'll just need to contact the FDIC for that to be attended to. They'll help you figure out what to do with your extra cash. Christine Benz, the Director of Personal Finance at Morningstar, said the FDIC was one of the healthiest and best managed entities during the financial crisis. So investors should take comfort in that. But, and this is a big but, not all investments are covered by the FDIC. How will this affect your 401k plan? With 401ks, we know you're concerned about your hard-earned retirement savings. But before you start panicking, let's take a deep breath and see what's going on. In the short term, the stock market may take a hit. The S&P 500 index was headed towards its lowest closing level since January, while the TBLE Bank Index tumbled nearly 7% at one point. But, as Mark Struthers, a financial planner at Sona Wealth in Minnesota, points out, this doesn't necessarily mean bad news for long-term investors. The SVB situation is unique, which means the risk of widespread contagion is unlikely. As Struthers puts it, if there were system contagion, it is hard to believe that the Fed would just stand by and continue to put pressure on the system. They have said as much in the past. They want to break demand and inflation, not the financial system itself. So what does this mean for your 401k plan? Well, in the short term, it might take a hit, but as long as you're a long-term investor, there's no need to worry. As we've seen in the past, the stock market always bounces back. In conclusion, the collapse of Silicon Valley Bank is a significant event that highlights the risks and challenges facing the banking industry today. While the full implications of SVB's collapse remain to be seen, it serves as a cautionary tale for investors and financial institutions alike. That's it for this video. Please like and subscribe to our channel for more informative content. See you next time. This is The Intelligence Show.